Welcome back to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hemoen, bringing you the latest developments in the real estate and mortgage industry right here in Ontario and across Canada. Today, we'll be diving into some significant changes that could potentially impact the housing market in a big way. The federal government recently announced a major shift in the mortgage landscape by increasing the insured mortgage qualification cutoff to $1.5 million. This means Canadians can now buy a home with a down payment of less than 20% at a higher price point than before. While this move aims to make home ownership more accessible, it has sparked a debate about its potential impact on home prices. Finance Minister Chrystia Freeland described these changes as part of the boldest mortgage reforms seen in generations. However, some industry experts are concerned that this could lead to upward pressure on home prices and intensify competition in the market. Nick Lecuyer, a mortgage broker from Mortgage Wellness in Barrie, Ontario, shared his thoughts on the matter. He anticipates that the rule change could result in price appreciation, particularly in areas where homes are currently priced just below the previous threshold. Lecuyer pointed out that in Barrie, there are several communities with homes priced strategically at $999. This pricing tactic is used because realtors and sellers know that pricing a home at $1 million or above could significantly reduce their potential buyer pool. With the new rules, he expects these homes to see an increase in value as more buyers can now afford them. Interestingly, Lecuyer highlighted a common scenario where buyers, constrained by the 20% down payment rule, would offer $999 even for homes valued slightly higher. This often leads to real estate agents explaining to sellers that their clients cannot exceed this price due to the current regulations. The new limit could shift this dynamic, potentially leading to more competitive offers and rising prices in these communities. Additionally, starting January 15, 2025, Canadians will be able to access mortgage insurance for building additional units, provided the property owner or a close relative occupies the current residence, and the new units are not intended for short-term rental. This change could further influence the market by encouraging the development of additional housing units. Despite these potential shifts, Lecuyer believes that the impact of the insured mortgage cap increase may not be as significant as some fear. He argues that the financial requirements to qualify for a $1.5 million home with a minimal down payment are quite stringent. This includes a household income of $300,000 and a monthly mortgage payment of $7,500, plus property taxes. The reality is, not many buyers are in a position to meet these criteria. On a broader scale, recent interest rate cuts by the Bank of Canada have started to invigorate the housing market. According to Robert Hogue, Assistant Chief Economist at the Royal Bank of Canada, these rate cuts have begun to accelerate sales activity, a trend that's expected to continue as further rate reductions are anticipated. This could compound with the new mortgage rules to create a more dynamic market in the coming months. Today, we're looking at a significant downturn in the new condominium market across southern Ontario. A recent report by Urbanation has highlighted a sharp decline in new condo sales, which have plummeted by a staggering 81% in the third quarter of 2023 compared to the same period last year. This drop represents the lowest quarterly sales figures in nearly 3 decades, specifically since the first quarter of 1995. The numbers are quite stark. In the Greater Toronto-Hamilton area, there were only 567 new condo sales in the third quarter. To put that in perspective, this is 87% below the latest 10-year average for third-quarter periods. Year-to-date sales are also down significantly, with a 63% decrease compared to last year and an 84% drop from the sales figures in 2021. With just 3,641 units sold so far, the GTHA condo market is on pace for its slowest year since 1996. Sean Hildebrand, president of Urbanation, described the current state of the new condo market as facing its toughest challenge in decades. He pointed out that investors are largely inactive, and end-user buyers have a wealth of lower-priced options available in the resale market. This combination of factors is contributing to the current slump in new condo sales. Despite the grim numbers, there is some optimism for the future. Hildebrand suggests that conditions will gradually improve. Developers are expected to hold back supply while construction inventory continues to drop. This, coupled with the anticipated rise in demand as interest rates decline, could help stabilize the market over time. One notable statistic from the report is the decrease in unsold new condominium units. These fell by 4.4% quarter over quarter, down from a record high of 25,018 units in the second quarter to 23,918 units in the third quarter. This is the largest quarterly drop in unsold inventory in 2.5 years, indicating a potential easing of the oversupply issue. Interestingly, there was only one new condo project launched in the third quarter, comprising just 177 units. This lack of new launches reflects the cautious approach developers are taking in the current market environment. Despite this, the number of condominium completions is expected to reach 24,386 units by the end of the year, slightly surpassing last year's record high. And looking ahead, completions are forecasted to climb to a record 29,409 units in 2025, before declining in subsequent years. In terms of pricing, the average price of unsold new condos has seen a slight dip. The average price per square foot was $349 in the third quarter of this year, which is a 2.4% decline from the same period last year. This price adjustment could be a response to the current market conditions and may play a role in attracting buyers back into the market. Urbanation, the real estate consulting firm behind this report, has been a key player in providing market research and in-depth analysis to the real estate industry since 1981. They've been closely monitoring these trends, offering insights into the shifting dynamics of the Southern Ontario condo market. RBC has issued a warning that the real threat to Canada's economy is not the anticipated wave of mortgage renewals, but rather a weakening job market. According to Nathan Jansen, Assistant Chief Economist at RBC, while higher mortgage payments will put pressure on household budgets, it is the potential rise in unemployment that poses a more significant risk to economic stability. Jansen pointed out that during the historic interest rate hiking cycle from 2021 to 2023, there was a persistent concern that a so-called mortgage renewal cliff would undermine the Canadian consumer and the broader economy. However, he suggests that the threat posed by mortgage renewals is manageable, especially with the Bank of Canada already cutting rates by 75 basis points, with possibly more reductions on the horizon. Although some households, particularly those with 4- or 5-year fixed-rate mortgages, will still face higher payments, these increases are expected to be smaller than initially anticipated as interest rates begin to fall. Additionally, homeowners who have built up equity in their properties may have the option to refinance or extend their mortgage amortization periods to alleviate financial stress. Nevertheless, RBC expresses greater concern over the current state of the labor market. Jansen noted that as early as a year ago, they emphasized that the 2025 mortgage renewal wave would be manageable as long as the Bank of Canada was cutting rates and the job market did not soften excessively. While the first condition has been met, the second is increasingly worrisome as recent labor market data continues to weaken. Job vacancies have decreased by 25% over the past year, and as hiring demand diminishes, the risk of rising unemployment grows. Jansen explained that higher mortgage payments reduce the overall income available for spending in the economy, but higher unemployment has a similar effect. RBC anticipates that a 1 percentage point increase in the unemployment rate typically reduces household disposable income by 0.5%. RBC's forecast indicates a continued modest rise in Canada's unemployment rate from its low of 5% in mid-2022 to 7% by early 2025. This marks a significant increase from the mid-2022 levels and is well above pre-pandemic unemployment rates. The concern is how much further unemployment could rise, especially with job vacancies in Canada having dropped by 25% compared to a year ago, and hiring demand now lower than pre-pandemic levels. Jansen pointed out that while job vacancies previously exceeded the number of people seeking employment, the situation has shifted, with unemployment now surpassing pre-pandemic levels. Any further decline in hiring demand raises the risk of unemployment rates climbing even higher than RBC's current forecast. The Canadian dollar has experienced a decline for the third consecutive week, primarily driven by expectations of significant interest rate cuts. This trend reflects growing speculation that the Bank of Canada might implement substantial rate reductions in response to evolving economic conditions. The depreciation of the Canadian dollar is partly attributed to market anticipation of a jumbo rate cut, a term used to describe an unusually large reduction in interest rates. Such expectations are fueled by various economic indicators suggesting a slowdown that could prompt the central bank to take aggressive measures to stimulate the economy. In recent weeks, currency traders and investors have been closely monitoring signals from the Bank of Canada, as well as broader economic data, to gauge the likelihood and potential scale of upcoming rate cuts. The Canadian economy has been facing headwinds, including weaker than expected growth figures and a softening labor market, which have intensified these rate cut predictions. While the possibility of rate cuts is seen as a tool to support economic activity, it also raises concerns about the implications for the Canadian dollar's value. A lower interest rate environment typically reduces the appeal of a currency to foreign investors, as it offers lower returns compared to other currencies with higher interest rates. The currency's recent performance is also affected by global economic dynamics, such as fluctuations in commodity prices and geopolitical tensions, which can influence investor sentiment and exchange rates. As Canada is a major exporter of commodities like oil and natural gas, changes in global demand and prices for these goods can have a direct impact on the Canadian dollar. Despite the current downward trend, some analysts believe that the Canadian dollar may stabilize if the Bank of Canada's rate cuts are perceived as adequately supporting the economy. However, the timing and magnitude of any rate changes will be critical in determining the currency's future trajectory. For now, the focus remains on the Bank of Canada's upcoming meetings and statements, as market participants look for clues on the central bank's policy direction. The outcomes of these discussions will play a significant role in shaping the Canadian dollar's path in the coming weeks and months. Let's take a look at today's best mortgage rates in Ontario as of October 19, 2024. With the mortgage landscape continuously evolving, it's important to stay informed about the latest rates and offerings from various lenders across the province. Starting with the fixed-rate mortgages, we have a 6-month fixed rate from Marathon Mortgage at 3.99% with a monthly payment of $2,364.65. If you're looking at a longer term, Meridian is offering a 5-year fixed rate at 4.09% with a monthly payment of $2,289.10. For those considering a 3-year fixed term, Meridian again comes in with a rate of 4.19%, resulting in a monthly payment of $2,413.67. Moving on to other fixed-rate options, Desjardins offers a 4-year fixed rate at 4.29%, requiring a monthly payment of $2,438.36. If a shorter term is more appealing, Equitable Alternative Solutions has a 2-year fixed rate at 4.99%, with monthly payments of $2,714.66. Now let's discuss variable rate mortgages. Manulife offers a 5-year variable rate at 5.30%, with a monthly payment of $2,694.60. For a 3-year variable rate, Radius Financial presents a rate of 5.60%, translating to a monthly payment of $2,773.09. Finally, CTBC Bank has a 2-year variable rate at 6.25%, with payments of $2,146.34 and a 1-year variable rate at 6.30%, resulting in $2,159.86 in monthly payments. It's crucial to remember that these rates are subject to change and may vary based on your individual financial situation, including credit score, income, and loan amount. Additionally, the rates mentioned do not include taxes, fees, insurance, or other additional charges. Clay Jarvis, a mortgage expert at NerdWallet, notes that October has been a relatively favorable month for Ontario mortgage shoppers. Fixed mortgage rates have settled around the 4% mark at some brokerages, making them more accessible compared to earlier in the year, when rates were around 5%. On the variable rate front, the Bank of Canada's potential aggressive rate cuts could further lower these rates. There is anticipation of a 50 basis point reduction in the overnight rate, which could bring variable mortgage rates down to approximately 4.8%. This makes variable rate mortgages an attractive option for some buyers who prefer flexibility. The Ontario housing market has shown some signs of improvement, with a 9.8% increase in home sales year over year in September. While new listings have reached a record high for the month, the average sale price in the province remains virtually unchanged from last year at $851,478. As we approach the end of 2024, many are curious about how the ongoing rate cuts will influence the housing market. Royal LePage's forecast suggests a 9% increase in home prices in the final quarter compared to the same period last year, indicating potential growth in the market. Before we wrap up, it's important for first-time homebuyers in Ontario to be aware of available assistance programs, such as the Land Transfer Tax Refund, which can help offset some of the costs of purchasing a home. Programs vary by region, so it's worth exploring the options in your area. That wraps up our discussion on today's best mortgage rates in Ontario. Thank you for tuning in to the Ontario Mortgage and Real Estate Insights podcast. Stay informed and remember that understanding the current market conditions can empower you to make the best decisions for your real estate journey. Until next time, take care.